And so this is a real yield. It's not sort of just like money printed out of thin air, which is what you sort of saw with Terra and Anchor, where there was no like real economic activity for someone actually paying for that interest rate on the other side. This is something that traders have been doing for as long as these futures exchanges have been around, for almost a decade now. Ethena is really just productizing and like tokenizing that yield into something that can actually be shared with users on the other
side. Well, we all know the stablecoin space is heating up with a battle brewing between Tether and USDC, but a new player is turning heads with its 30% plus yield and structure to create a so-called synthetic dollar. And with us today is the man behind it, founder of Ethena Labs, Guy Young. Guy, thank you so much for coming on Coinage, man.
Yeah, appreciate you having me on. Thanks.
A lot to get into today. Obviously, want to explore kind of what the difference is between a synthetic dollar and what the difference is between a stablecoin, where the idea came from, growth, because y'all are growing really quick, as I said. But before we dig into all that, I want to start with Guy Young, the man himself, and your background and why Ethena's working so hard on this. I mean, what to you was kind of the aha moment for why Ethena needed to be started?
Yeah, sure. So I guess my background before starting out with Ethena, I was working in traditional finance. So I was at an investment fund looking at financial services, investing into banks, insurance companies, specialty finance, those type of businesses. Had been involved in crypto since late 2019. Had a friend who was a DeFi founder back then who just introduced me to Ethereum and the applications being built on there, and was immediately interested by what was going on. So the actual inspiration behind the idea with Ethena wasn't actually myself. It was actually Arthur Hayes who sort of had the original concept, and his vision was essentially just trying to disconnect a dollar from the existing banking system. So the way that he articulated the argument was he sort of saw stablecoins as one of the most important assets within crypto, whether it's for trading or just storing value and sending it across the world. But we never had really like created our own form of money. And so his idea here was that you'd sort of take crypto collateral, whether that's BTC, ETH, Solana, whatever the asset is, and then you're hedging it using perpetual swaps. And the idea here is that you're long on one side and short on the other. And the net output of those two things is that you create a synthetic dollar out of those two things netting off. So yeah, that was his original vision, was quite inspired by it, and just quit my job to start doing Ethena after I read that piece.
Yeah, and I know obviously, for people in the space, a lot of this makes sense. I was chatting with someone last night who's not in crypto at all, more of a TradFi guy, retired now actually, just talking about why there is so much a need for, things outside of Tether or USDC in terms of stablecoins being backed by dollars in a bank. When people ask you that, and also maybe ask what's the difference between a synthetic dollar and stablecoin, I mean, how do you answer it to people who aren't in crypto?
Yeah, I think the very basic answer to that is that the backing behind a normal stablecoin is you're essentially holding T-bills or bonds or repos in a bank account or an SPV sitting in the real world. That obviously has a very obvious like custodial risk, where you're essentially trusting that like the custodians and the banks that are actually holding the assets there will sort of like honor the assets actually representing the stablecoin on chain. The difference here is that we're actually just moving collateral that sits within the existing legacy system into crypto collateral within our own ecosystem. And I think that sort of segues into the question of why is this important? Why should it actually exist? I think it was we could see this clearly as like the beginning of 2023. If you remember when we had the SVB issues with USDC, the entire space like didn't really know what to do with itself when we were going through that period where every exchange, every DeFi application, it all depended on the fact that we had USDC and other fiat stablecoins at one, and that actually the collateral there was in a safe place. I think what we learned that weekend was that we couldn't have our entire system sort of relying on the US banking system, and there is some value in basically creating diversification away from that custodial risk. And so in essence, all we're doing is just really replacing the custodial risk of assets sitting outside of our own ecosystem to one that's sitting within it.
Yeah, and it is interesting. I mean, obviously, the Silicon Valley Bank problems, not just a problem for crypto and USDC in terms of how it really hasn't really recovered since that happened, but also for the traditional banking system and other banks that were levered to it and startups as well. So everyone kind of went through that. I'm looking at kind of the top stable coins now. You guys are sitting there squarely within the mix. It has been interesting to see your guys' climb by my count. Definitely top 10 in the stablecoin space. And even aside from that is just like how quickly the market cap of Ethena's USDe has hit 2 billion. I wonder in terms of the growth as you've seen it, a lot of people will see 30% yield. You can get into kind of like how you're delivering that yield and how it fluctuates. Very different than maybe examples in the past. But I have seen people compare your project to Terra. I know that it's definitely not a fair comparison one-to-one. We can get into why. But what do you ascribe that growth to? Because I think it's only been like a few months for you guys to cross 2 billion. Terra, I think, took like 6 months. So the speed is faster. What are you seeing that's working right now?
Yeah, I think we've got to acknowledge that there was like a huge element of luck just in terms of the timing that we came out to market. So just addressing your question around where does the source of the yield actually come from? Really, the main source of return is actually when you're shorting perpetuals, you tend to get paid typically a positive interest rate for doing that. The conceptual sort of explanation for why that makes sense is typically people want to be more long than they want to be short within crypto. They think the number is generally going up through time, and like your upside is infinite while your downside is just losing your money. And so naturally there is like a long bias to the market. And so when you're coming in on the other side to say I'm going to take the short position, to people who wanted to express that view with leverage, they're typically willing to pay a very high interest rate for you to do that. And so this is a real yield. It's not sort of just like money printed out of thin air, which is what you sort of saw with Terra and Anchor, where there was no like real economic activity for someone actually paying for that interest rate on the other side. This is something that traders have been doing for as long as these futures exchanges have been around, for almost a decade now. Athena is really just productizing and like tokenizing that yield into something that can actually be shared with users on the other side. Anyway, all of that's for me to say that I think the moment that Athena came to market was just a very unique moment in the market where there was obviously a lot of bullish sentiment around the ETFs and prices were generally going up. And in those moments, it was rational for traders to be paying a 30, 40, 50, 60% interest rate because they thought that the underlying was moving as quickly as it was. And so really think about Athena as just like harvesting that speculative premium within the market and just sort of like delivering that to users in like a dollar format on the other side. So
Yeah.
I think obviously the team did a good job executing, but it was a huge part of luck in that as well.
Yeah, let's compare and contrast again. I think with Terra, because every interview that I've seen of you, I want to be sure that we're clear on it. In my background, especially as someone here at Coinage, we covered the Terra collapse first with the first interview Do Kwon ever did, and I can understand why you would definitely want to contrast with the largest ever collapse in crypto. And I guess the other thing too is you've got the stablecoin and you've got Ethena the token. I think one question in terms of everyone, obviously the way that Luna and Terra worked is very different again than what's going on here. So what has been your biggest kind of way of explaining how Ethena the token ties into everything?
Yeah, I think that's actually the biggest point to actually highlight here to your listeners in terms of the difference. So the key piece of Luna that was sort of so fragile was actually that the Luna token was used to collateralize UST. And so the system was like fully endogenous to itself. And that's why you sort of saw that death spiral type dynamic play out in the end. The key piece actually with Athena is that the Athena governance token has absolutely nothing to do with USDe itself. USDe could exist without Athena the token existing. And you can just really think about the key difference here is USDe is collateralized by external or exogenous assets like BTC, ETH, or other crypto assets. And the governance token of Athena has absolutely no role to play in that. So that if you do sort of see market unwinds or whatever, USD is not sort of affected by Anna's sort of performance during that period.
Yeah, and I guess, again, there are other compare and contrast points we can get into, but one that I've seen recently is, and one that you've mentioned in other interviews, is the idea that yield percent that has attracted a lot. I'm looking at a tweet from Meltem Demirs here, just kind of looking and comparing yields across different stables and Athena. And the piece to highlight there being that the yield fluctuates and could go down, versus with Anchor, it was set at 20% and stuck there forever. I mean, that also to me seems like a pretty key piece of this. As you mentioned, kind of in a bull market right now. Maybe some people would disagree that we are or we aren't. I think we are. How do you see that kind of changing in bear markets when things start to flip, and what should people be aware of?
Yeah, you're exactly right. So the yield here is completely variable. We've actually seen that in the market wipeout that you saw at the beginning of April. Funding sort of collapsed from an area that was between 30 to 50%, call it for the month before, to less than 10%. And that's really core to like the design of what Athena is doing, which is just saying this is a market set interest rate. We're just providing the infrastructure and the plumbing for people to be able to access that interest rate. And if it's going to be high, then great, Athena will grow. And if it's going to be low, then Athena is going to shrink to a size that sort of makes sense there. It's just very like sort of core to my philosophy around these things, which is like you got to let the free market actually decide these things. And the more that you try and step in front of these free market interest rates or demand and supply, the more painful the breakage is going to be further down the road. And so, yes, I guess the response there, and I don't mean to sort of dismiss the question, is actually Athena will shrink, and that's actually part of the design, which I think sort of keeps it more healthy and sustainable going forward. I think a valid question here, though, is like through the cycle, what does it look like in a proper bear market where sort of like the yields could potentially go negative? We do have like a large insurance fund that sits behind USDe, which has been built up for exactly that purpose, and also having like a bit of staked ETH yield as well helps to sort of cover for that. And the idea, very basic idea here is when times are good and the yield is so excessive to the upside, you're clipping a bit of the yield and putting it in a rainy day fund. And then to the extent that sort of like funding comes down, the yields are less attractive. You can sort of tap into that when times aren't as good. So
Yeah.
yeah, that's sort of how we think about this performing through the cycle.
Yeah, I'm glad you mentioned that too, because it caught my eye, and again, in kind of like looking at how is this different than Terra, because that's the lens that I guess I've looked through, and probably a lot of people looking through. We can get into kind of how that's been for you, because building in the shadow of something like that is, I think, probably unique to you as well. But I was looking at the insurance fund, and I do think it is important to highlight for that reason. I don't know if these numbers are accurate or not. You can correct them if they aren't. But looking at a little bit above 35 million in this reserve fund, according to this one risk radar, and kind of, I guess, how should people think about those risks? Just to ask the question around, in the idea of kind of where things might go if you do see protracted funding rates flipping into the negative. Is this basically how long you'd be able to go with those insurance funds? I mean, what happens in that instance? Because I guess you'd have to hedge to the other side. What do those risks look like?
Yeah, I think to those graphs specifically, it does miss quite a bit of detail there, which is actually like quite a simple answer to the whole thing, which is you can just close down the positions if the
Mm-hmm.
funding is that attractive. So you're sitting in a very basic example, long $100 of ETH and then short $100 notional of ETH perhaps. You can always just close that and sit in dollars essentially. And so really the moment you're covering for is like how long does it take you to close down all those positions? The perps market is like one of the most liquid in crypto. In fact, it is the most liquid by an order of magnitude. And so your ability to actually get it in and out of like billions of dollars of perps in a day is actually doable. And so really the question here is like, if you do want to wind down everything and actually just sit in dollars or another stable coin or an RWA or something else in one of those sort of like nuclear scenarios in a bear market, you do retain that option to be able to do that. I think the other comment is around negative funding generally, and it's something that we saw even as recently as this last month, is that it really tends to persist for very short periods of time. So funding did go negative on that weekend in April. I think it was around the 14th of April. It was for literally 30 hours where you saw negative funding, and then the market sort of like flipped and came back. And even at like the
Mm-hmm.
deepest moments of the bear market in 2022, when Luna was blowing up, 3 hours went down, FTX, like the maximum period that you saw was anywhere between like 4 to 7 days, depending on that event. And so these like really extended periods of negative funding have just never been anything that we've actually seen. And there's like structural reasons for why that is the case. Just as one very basic example here, if you're a large holder of spot ETH or BTC and funding goes like slightly negative, you're incentivized to just swap your BTC and ETH spot holdings into a perp that's actually paying you to be long. And there's just a very natural sort of like flow that comes from spot into taking the other side of the position until it does become positive. So yeah,
Yeah.
those sort of things come together, and it's not something that we sort of have seen or expect going forward for super long periods. And you can always just close down the position if you need.
Yeah, I think that's a good answer in terms of, again, answering the question of how this is different. And I do want to highlight that because I think it would be doing a disservice to just rope your project into things that have happened before. And I do wonder also, as we talk about how big Ethena might get, as I said, over $2 billion now, the larger you guys get, I wonder if it makes entering or exiting those positions, as you mentioned, pretty deep right now. But the larger you guys grow, I wonder if it then becomes a little bit trickier as you become such a huge player in the perp futures, or depending on how you're hedging, if it becomes a problem of your success where you start to move the markets as you make these moves. I mean, how do you see the growth impacting that piece?
Yeah, so there is definitely constraints as to the size that Athena's USD can actually grow. So as one very basic constraint, it's unlikely that would ever be bigger than, call it, 35 to 40% of the open interest of all derivatives within crypto. It tends to be where exchanges start to like actually cap you out on each contract. There's another mechanism here, which is that the larger that we grow, the lower the interest rate becomes, because we're sort of pushing more and more shorts into the market, which brings the funding rate down. And so there's actually like a very natural, like anti-reflexive mechanism to this, which is as we're getting bigger and bigger, the interest rate is getting less and less attractive. And then so the growth kind of like slows down as it does get bigger. In terms of like the question of what does that number sort of look like right now, I think somewhere in the order of like $10 billion is where like Athena right now would naturally start to cap out and start to like really distort the market in terms of funding. And that's where we sort of expect users would slow in terms of the speed that they're becoming to the product. But yeah, you're absolutely right that actually the larger Athena gets and the more dominant it is in terms of liquidity, the more you just need to be able to manage the speed at which people can sort of come out and sort of like redeem from the protocol at a reasonable spread. So that is like a key risk that we've sort of highlighted within the documentation, which is there is a risk of like liquidity and slippage to get both in and out. This exists in most things. So if you think about like a Uniswap transaction, there is a cost to get in and out of the trade. And when there's lower liquidity, there is just a cost to that. And that's just something that we sort of express to users, which is to swap in and out, there is a cost. And sometimes that cost does change.
Yeah, no, I think that is an interesting piece of market dynamics that we've seen time and time again. Is no matter which market you're in, I suppose depth does matter, and how big of a market it is. You said 10 billion is kind of the number to watch. Forgive me for not knowing this off the top of my head, but I'm sure this is something you guys watch all the time. And it is hard to track globally. I mean, in terms of the size, you mentioned how large, I mean, it's Bitcoin that you guys added not too long ago for kind of collateral on top of this. I assume probably by far and away the most deep market for futures for Bitcoin. I mean, what are the numbers right now, and how do you kind of contextualize the growth of the futures market in the crypto space for people who don't know?
Yeah, so at the moment, across majors at the moment, it sort of oscillates anywhere between 30 to $50 billion, depending on when you're looking at it. And then Solana's grown pretty large this year as well. So that's kind of where the 10 billion number actually comes from, which is like roughly 30-ish% of the total majors open interest. I think is like a reasonable upper bound for where Athena could get to. To your question around like the growth rate of these markets, it is quite interesting actually to see the growth rate of derivatives is actually it doesn't sort of grow one for one with actually market cap. So what we saw last cycle was actually as the market cap increased by 1x, the derivative market grew at like 1.3 to 1.5x, depending on which instrument you're looking at, which actually means that, like the numbers I'm giving you there for like Athena's size at 10 billion, it's sort of like for the market as we see it right now with BTC and ETH at the price that they are right now. But if BTC and ETH were to double from where they are now, typically we've actually seen the derivative market more than double in size going forward. And so that has like sort of a quadratic impact in terms of the market size that we think that Athena can get to going forward, assuming that the market actually grows.
Yes, it's kind of a bet on growing with the market at the same time, I suppose, and avoiding those issues as you grow sustainably. And of course, right now, it seems like that's happening. I want to highlight, too, though, in terms of the growth and people turning to USDe, this was a story recently out in Bybit integrating your guys' stablecoin as a collateral asset in trading pairs as well. And I think I mean, again, not to belabor the point and compare this to other stablecoins or attempts at this, but I mean, I guess, how do you see Ethena's stablecoin synthetic dollar mostly being used? Is it always going to be in the trading space, or are you still also making a bet that eventually this will become something that anyone, an average person, uses for transactions just as well?
Yeah, I think the predominant use case is always going to be for like crypto native users who either want to use it for trading on centralized exchanges, using it within DeFi as collateral, or just as like a very basic savings asset. I sort of view actually like stable like assets as just really performing two basic functions. One is you want to have liquidity to trade in and out of another asset, and that's what USDT and USDC do very well. And then the other one, which is actually a lot of people actually just use stablecoins or stable dollar assets for savings. So like it's a great store of value if you're holding currencies that are outside of the US to just hold your money in a dollar that has a yield. And so we actually see that savings function as one of the more important ones, and doesn't have to be for like speculative activity for trading on an exchange. It could just literally be, I want to hold this and capture a yield and actually just save my money. I don't sort of see USDE being used in sort of like fintech payment type integrations where you see USDC a lot. I think that's just a game that they've sort of played very well in terms of their BD and the relationships that they built. And I think just naturally the risk that sits behind Ethena and its construction looking very different, it's just unlikely that we sort of get put into those kind of places. But there are some very interesting sort of like middle grounds there where, and this is just an example, nothing's sort of been done here, but you've seen like interesting integrations with like Tether and Ton, for example, where you can sort of like send and spend money on your Telegram app using USDT as payment there. I think that's super interesting because you're like crossing over with a crypto native crowd that's using Telegram and the huge amount of users that they have. And
Yeah.
maybe something that we have like a savings product that sits alongside it is like an interesting sort of balance to that. So yeah, I do think there's a bunch of different places it can go. It's not just for traders. And like fundamentally, a dollar is kind of like the only crypto product that everyone on earth kind of wants to use, and you can imagine using going forward. It's basically just a product that everyone on earth wants access to.
Yeah, and like I said, a lot of people have tried, a lot of people have failed in building something that is not just backed one for one in dollars. And as you said earlier on in this interview, there's always risks of even that when we think about banks and potentially failing and being able to access the capital that backs these stable coins. Bringing it back to a personal level, Guy, when we think about your mission and how it differs in comparing to Do Kwon, it sounds like you guys are aligned in the idea and the want to have a stable coin that does not touch traditional banking rails. That was, of course, kind of the golden goal of what Terra was trying to accomplish. I mean, what do you want out of this project? Is that the same thing? And kind of where do you see this going for you personally?
Yeah, I think for us, it's actually just trying to provide an interesting asset that we can like build upon in the rest of crypto. So I think the bit that I was like most drawn to originally when I got into this space, like I mentioned in the beginning, was actually around DeFi, and I think you've seen it with like the applications that have started to integrate with USD on chain. It becomes really interesting when you have a new asset with a different kind of like yield profile to start building new and interesting things. Whether it's like yield products that you see with like Pendle on fixed to floating rate swaps, some of the leverage stuff that you see on money markets like Morpho and Aave, all of this sort of like financial engineering and experimentation that you've seen built upon USD, the asset, is just
Yeah.
something that I find like really intellectually interesting and like exciting to sort of work with. And so I think the vision of where we want to take this is sort of start with USD, the asset, which we sort of see as one of the killer products of crypto, which is just money, and then use that to then build a system of interesting like financial applications on top of it, which I think is like the next step of where we go.
Yeah, and I think, like you said, it was interesting to hear your response on timing because you said you're lucky, and I think, launching any project right now, most founders would say they're lucky because of kind of where the market's at. I do wonder, you personally, if it's annoying to ever have to answer questions that tie back to Terra or talk about risks. I ask them because I also lost money in the Terra collapse, but, as someone who's building in the space, is it annoying to have to build in that shadow?
I wouldn't say annoying. I say it's perfectly legitimate after what we saw last cycle for people to ask these questions. And if we didn't, I think that would be more worrying. And I think it's just a difference in approach that I've had seeing some of the mistakes that were made last cycle, where people would come up with valid questions or criticism and would just sort of be shut down. So it's just a very different approach from my side, which is I want to engage with these risks. I want to have these discussions so that people are at least aware of the type of products that they're walking into. And that's sort of the most important thing from my side, which is treat people like adults. They can make risk decisions by themselves. So I think it's one of the more beautiful things about crypto is that it sort of enables you to make those decisions. But you should just do so like with teams that are being transparent and honest around what the risks actually are. And that's just sort of what we focused on our side. So not annoying from my perspective at all. And I think it's just my job to sort of explain why it is different and why our approach is different for users to make their own decision.
Yeah, and I appreciate the answers to all the questions that we've asked you as well. One of the last ones here is in terms of projections, roadmap, and how quickly you think this project will continue to grow, because as I said, it's been impressive to start the year. And now as you look ahead, I mean, what are the numbers that you're projecting in maybe closing the gap between Ethena and some of the other major stablecoin players?
Yeah, I think for us, it's probably in the next, call it like 6 to 9 months, it'd be quite nice to cross a sort of like $5 to $7 billion range in USDe. And we're just working on the idea that I had in our roadmap that I posted like last week, which is around just building a chain and like ecosystem around USDe. And then this idea of sort of an exchange that might be plugged into Ethena's liquidity. So for us, it's I think short-term targets of 5 to 7 in the next few months, and then just working and developing on some of these other initiatives for the longer term.
All right. Guy Young, the founder of Ethena Labs. I appreciate you taking the time to chat with us today, man. Thank you for answering the questions. Thank you for coming on. And please keep us posted as we continue to see you guys doing the work out there. Appreciate you taking the time.
Thanks, man.